Hello, from LPL Financial, welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. It's Quincy Krosby. It is Tuesday morning, December 27th, and it is The Talking Point. Hope all of you had a warm Christmas and are bailing out of the snow if you're in the snow belt and ice belt, which seems to be almost everywhere in the country. I hope everyone is safe and sound. This morning, the market is futures market. I'm doing this call before the market opens. The futures look higher. A couple of things that we are paying attention to in terms of the news is that China, over the weekend, announced that the very last zero COVID restriction that has to do with quarantines for those visiting, coming into China. So I say visiting because it could be Chinese coming back in. It covers everyone coming into China. Will not be subject to an 8-day quarantine. Rather, they have to have a COVID test within 48 hours of going on a plane and coming into China, landing in China. That basically is the last restriction. So they have gone from complete lockdown to, okay, it's over, get over it, deal with it. And of course, you know that they're still reeling from the spread of COVID. You may have seen in the news that they are eating lemons like crazy because, again, they want to build up their immunity. The vaccine program has not been particularly successful. There's no herd immunity the way we have it in the West. And people are just vulnerable. So they've been eating canned peaches. I think they've run out of canned peaches. And also lemons have become a major commodity as folks just want to build up their immunities naturally. Now, the other thing I do want to point out is that this announcement about lifting this very last restriction has, underpinned a trader's market again. Obviously, investors want to go in. They're looking for areas that are going to be attractive. But even though the authorities have said, okay, zero COVID, gone. Now let's let the economy grow. They still need to bolster the economy. They have announced that they are going to try to introduce stimulus programs for consumer consumption. To have consumers buy things, kind of pent-up demand that we saw here in the West. And also the private sector, that they want to bolster the private sector. This is interesting because obviously they didn't have to mention the private sector, but they did because they know that private enterprise in the West and in the East actually does help the economy. The other thing that we're paying attention to are any announcements regarding the really debt-laden property sector, which, by the way, in China is a major portion of their economy. But the private developers are in terrible shape. Many have defaulted on dollar-denominated loans that they have received, and others are on the brink of default. The government so far has introduced, via the banks, programs whereby these developers can go in and borrow money in order to pay their debts, but in order to finish condos that were just basically left abandoned during the restrictions when they were in place. So it is a very important part of that economy. And I think that not traders so much. Traders have been in the Chinese market, either in mainland China or using the Hong Kong index from the get-go. In other words, any sign, even rumors that they may abandon the zero COVID policies, traders have been there. Longer-term investors are looking for actual implementation of measures to bolster the economy and to actually make this transition from zero COVID to, hey, guess what? We're reopening, learn to live with it, a little bit more smoothly. So all of this is still in play. But I did want to mention that other thing that we're seeing today in the markets is that some of the sectors within South Korea, for example, and Japan, which are expecting to have visitors from China. You know, those folks are kind of like the way we were when we were kind of locked down here in the U.S. Once we felt safer, hey, let's go and visit family. Let's go to Europe now that the dollar is stronger than the euro. We did that. They expect that the Chinese are also going to do it. So in other words, travel stocks in South Korea and Japan are climbing higher. Also consumer discretionary names with the expectation that the Chinese are going to, you know, start buying things again. That's the goal. But also, obviously, the authorities want them to do it within China, visit family whom they haven't seen, start spending. And nonetheless, and I do want to stress this, it's going to be a difficult and arduous transition. There's going to be voluntary, not government-imposed restrictions, but voluntary restrictions as COVID continues to work its way through the country. Not just this particular variant, but others. Now, here's the important point that I want to mention, because I'm paying very close attention to this, and that is when they introduce another vaccination program. They've stayed with a kind of nationalistic Chinese vaccine. It hasn't been very successful. The question is, will they develop one with the technology that was used in the West? That is to say, the one that we saw with Moderna, the one that we saw with Pfizer, with its German partner, BioNTech. That's going to be important, because if they adopt and even structure it to have it be Chinese-led, because, you know, in terms of nationalism, so to speak, it is going to be very important, because that has helped very much the West get back on its feet and basically learn to live with COVID. So this is important. I do want to mention that today we're seeing oil prices higher. This is despite the concerns that the global economy is going to go into a significant slowdown, a slowdown that would, you know, hinder demand for, for travel. Nonetheless, the promise of a reopening in China has helped push up some of the industrial commodities and also oil. Remember, China is the world's second largest economy, even with the languishing economy that they've had for over 2 years, and also the largest importer of oil. So West Texas Intermediate Crude, WTI, is up, but so is Brent, which is the global barometer for oil. Coming here to the U.S., I do want to mention that this week, really, according to the statistics and the almanac, yes, the Trader's Almanac, is really the beginning of the Santa Claus quote-unquote rally. It is the last trading days in December and the first few days in January. But over the years, this how shall I say, strict interpretation of the Santa Claus rally has been, how shall I say, kind of massaged, eased, and basically it looks at this week, but also more than just a couple of days in January. Now, remember, it is predicated on new money coming into the market. We have to remind ourselves of that. And typically, one of the reasons we talk about the Santa Claus rally in much of December, not just the last trading days in December, is that the large portfolios, the institutional portfolios that have trillions of dollars actually, have already moved their money. They've already repositioned for this year. They do it early. And this year, most likely, we probably saw selling, because we just looked at the numbers, selling in equities and moving more and more into fixed income, which has seen, particularly with the Treasury market, offering very nice returns, and investment grade offering very, very nice returns. I won't get into it in this call, obviously, but we've seen more of that positioning and allocation taking place toward the end of the end of December rather than just this week. But I do want to get back to the absolute. That is to say, according to the Traders Almanac, yes, Santa Claus rally this week and going into the first trading days of January. So those who are hoping that Santa Claus leaves something more than just coal in the portfolios, we still have time. Also, this week in terms of data, actually not that much. We still have some home price data coming out today. It is the Case-Shiller Home Price Index, which obviously is expected to be down. But the question is it getting less bad? That's what we always look for. Is it getting less bad? Doesn't sound scientific, but let me just say, when you start putting it on a chart and seeing that the data releases are less bad, you know that you're moving towards a change or a transition in terms of the particular data that you're looking for. In this case, obviously, the housing market. So that's going to be today. And then tomorrow, Wednesday, we'll get pending home sales. You know, in terms of that data, we did see last week that new home sales getting less bad. Now, why would that be? Well, how about this? How about that the builders have all of these houses that they want to unload, essentially, and basically they're forced to lower the prices and give away more and more of those, upgrades that we pay a lot of money for in order to just get rid of them. And that's what we've been seeing with the home builders. Nonetheless, when the data came out, the new home sales actually showed an improvement. Then tomorrow, again, Thursday now, we're going to look for the continuing jobless claims. Last week, the continuing jobless claims were actually better than we had expected. Now, remember, in the eyes of the Fed, that's, hey, wait a minute, we want to see an increase in continuing claims. Because again, the whole goal is that the worker does not have as much leverage in terms of hourly wages. That's the thought behind that. Now, all of that said, one of the reasons that we're seeing that continuing claims inching higher, although last week it wasn't the case, is that it looks as though folks are having a little bit more difficulty getting new jobs. That's the thinking behind it. And then if you go along with that thread, the idea is, well, wait a minute, maybe, just maybe, we will start to see wages starting to come down. That's what the Fed wants. And remember the reason. It's that wages are an important input cost. And the higher the input cost, the more that the small business owners, large corporations are going to try to pass that along to, to the buyers, whether it's, us, the consumer, or another company buying what they have to offer. And therefore, that creates higher inflation. That's the idea behind it. The Fed will talk about it in a different way. They say they want to create an equilibrium within the labor market, but really it is about trying to bring wages down so that inflation also comes down. Now, also on Friday, then we are going to have the Chicago Purchasing Manager Index report. These are important because what they suggest is, what are the conditions in these areas in the country? Chicago, the bigger area, very, very important. And they talk about new orders, they talk about exports, they talk about hiring expectations. And on the manufacturing side, it doesn't look that great. So this will be important for the market. I also want to point out that normally during this period, the volume in the market is quite low. And that means it can skew the market in one direction or another, particularly with commodities or the U.S. dollar. Just want to point that out. Lower volume can push in one direction or another. And you'll hear many of the very experienced traders, those are the guys I worked with, say, well, you know what, I'm not going to take this as gospel, that the one commodity moving much higher versus lower during this week, because again, it can be skewed by the lower volume. The other thing I do want to mention about this particular week is that because oil prices are actually inching higher. We will probably see gasoline prices, oh yes, start to actually climb higher, not lower, but climb higher. The reason I'm mentioning this is that last week we saw that consumer sentiment rose. Yes, it climbed higher. And we know that there is a direct positive correlation between, yes, gasoline prices and consumer sentiment. We saw this over the year when gasoline prices came down, consumer sentiment actually started to edge higher. When consumer sentiment went way down, it was when gasoline prices were very high. Doesn't even matter if you drive. The reason is, as long as you are passing, even as the passenger, those filling stations, gasoline stations, every single day, you saw those prices move in one direction or another. And the U.S. consumer wants that to go down, not up. So we're going to pay attention to how much higher we will see the gasoline prices go. A lot is going into oil. Now, because everyone I know asks me about the energy sector, because at LPL Research, it's one of the sectors that we have an overweight on. The energy sector is not just about the underlying price of natural gas, for example, or oil in this case. It also represents what are companies doing. Are they giving back to the shareholders? Are they doing share buybacks, which we are seeing, by the way, in the energy sector, major share buybacks. They're also sweetening dividends and special dividends. That's what the analysts look for in any sector, by the way. But obviously, people are concerned when the underlying commodity starts drifting downward, and we've seen that with oil. But nonetheless, you still have issues, supply shortages, right? You have the Biden administration announcing that they want to start replenishing the Strategic Petroleum Reserve. Remember, the administration took oil out of our Strategic Petroleum Reserve in order to lower the price, yes, of gasoline. Now they're going to replenish, and what that means is that the integrated names, those large energy corporations, will cut a deal with the administration about a price and how much they are going to take from their own reserves and give it over to the Department of Energy. So that is something else that is helping to underpin oil prices. In other words, oil being taken from one reserve and moved into the Strategic Petroleum Reserve. Another thing is, again, Russia. Russia made an announcement that somehow that they may just cut the amount of oil production if they don't get enough money from the exports. Remember, there's a cap on Russian exports right now, a cap that was imposed by the European Union. So they're trying to find a way that actually they can, push oil prices higher. Oil prices for them are extremely important because the oil income is what helps them in their effort, in the war effort vis-a-vis Ukraine. So all of this is important, not to mention, I want to just put this out there, that the OPEC Plus actually can come out and say, hey, you know what, we're going to cut production even more. Remember, they announced a cut of production one meeting ago, and oil prices actually climbed higher. They do not want to see oil prices sink, because it is obviously right now a major source of revenue for those countries. They understand that at some point the countries in the West are moving toward a transition towards solar, towards electric vehicles, and that demand is going to go down. So they want to take advantage of this transition period when fossil fuel is still very important. Natural gas, very important in terms of reliability for the global economy. So all of that plays in. But the immediate today, oil prices climbing higher, is the announcement that the very last measure that China had imposed for zero COVID policy has been lifted, and that is the quarantine being lifted. So here we go. It's a busy week, but not that busy that there are countries that don't celebrate Christmas, that don't celebrate even this New Year's. So there's still a lot going on. But overall, it is a week that most of the trading desks are quiet around the world. And again, as I said, we still have the markets that are moving. And remember, Santa Claus may not be finished. Yes, this week and early next week, Santa, busy. He's been busy. It's been hard for him. He travels and it's cold out there, freezing. So he still may have some presents for the markets. Take good care. Please don't hesitate to call me this week. I am working. I'm answering emails, I'm answering questions. I'm also doing a lot of cleaning and scrubbing and cooking, like everybody else, multitasking, but I'm focused on anything that your clients or you want to discuss. I'm available. So take good care. We'll be back next Tuesday, right? I was ready to say Monday, next Tuesday. Thank you all very, very much. And I want to wish everyone a very strong 2023. We will turn the corner sometime in 2023. That's what my crystal ball is telling me. Take good care. Bye-bye. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.